Debt can have a negative impact on your future goals, perspective on life, your ability to retire in comfort, and even your overall enjoyment of life. Sadly, many of us have learned the hard way that debt can have a significant influence on a person's life. Think about how much better you would feel if your debt was completely paid off. Instead of sending money to your creditors, you would be able to spend your money any way you want. Getting out of debt can be a very liberating experience. Paying off debt requires focused effort and a well-planned strategy. However, if your current plan is to make minimum payments until your debt is paid in full, understand that the minimum payment is designed to maximize the profit of the credit card company. Assuming you don't use the card again, it might take 30 or more years to pay down the entire balance. Do you really want to be burdened with that much debt for the next 3 decades? So, which approach to debt reduction is right for you? Oftentimes, the best option varies widely depending on the drawbacks that each choice presents. Welcome to the Seth Rain Money Guide, where we discuss ways to help make money work for you, instead of you working for money. Today, we're going to talk about 6 different debt reduction plans and the risks associated with each one. But before we continue, please subscribe to the channel. Also, don't forget to tap that bell button so you can get notified when we upload new content. We upload videos that cover a wide variety of financial topics on a weekly basis, and we want you to be there for every one of them. Now, let's get started. Number 1, debt settlement. Debt settlement is the process of negotiating a decrease in the amount of debt you owe to your creditors. During the debt settlement process, you stop making payments either because you are unable to pay your debts or because you are attempting to obtain leverage. Stopping your payments is a crucial component of debt settlement, since the creditor has little motivation to accept a settlement if you continue to make payments. The goal is to persuade the creditor to take a lower amount of money than what is actually owed. They are more likely to agree to something now than lose their chance altogether. In most cases, collection agencies can settle for less than the amount owed. One-time payouts are the most common, and they're often approximately half of the entire amount that is owed. The fact that you are not making payments will be reflected on your credit report. Saving money to pay the settlement will take some time, and you may be recorded as overdue during that period. The creditor calls will likely be relentless while you're trying to save money, but they are probably the least of your worries. There are potential tax consequences that come with debt settlement. For example, if you can reduce a $10,000 debt to $6,000, you will save $4,000. However, the $4,000 that you saved might be taxed as income. If your total assets are less than your total liabilities, then you will be considered insolvent by the IRS and you will not have to pay taxes on the forgiven amount. You can pay a debt settlement company that will work with your creditors to settle your debt. Usually, they will charge a percentage of the total debt reduction. Debt settlement can take a lot of time. You will have to miss several payments before creditors will be willing to negotiate a settlement. There is also a possibility that the creditor will file a lawsuit against you if you fail to make payments. However, a lawsuit is unlikely in most situations for several reasons. Lawyers are expensive. It's just not worth the expense for the creditor to take you to court unless you owe a lot of money. There is also no point in filing a lawsuit if you don't possess a lot of assets. Debt collectors can be relentless, but they are highly unlikely to take action that leads you to consider bankruptcy as a viable alternative, because then they will probably not get anything at all. The most important thing to do with a debt settlement is to make sure you get everything in writing before you agree to a payment. Never believe anything the debt collector tells you over the phone. Number 2, debt consolidation with a home equity loan. If you are a homeowner and you have sufficient equity in your home, you can use a home equity loan to pay off your credit cards and other debts. Home equity loans allow you to better manage your debts with a reasonable interest rate. The money from the loan is allocated to your debt, and you only have to make a single monthly payment. In most cases, qualifying for these loans is easier because the loan is secured against your house. Your credit score is not negatively impacted when you take out a home equity loan. It can actually improve your credit score as long as you have no existing home equity credit line open in your credit history and if you keep up with your payments. The amount of credit that you are using is one factor in your credit score. Having additional credit accessible to you enhances your utilization ratio. A home equity loan will also help your credit if you are already behind on your debt payments and are now able to pay them off in full or get back on track with on-time payments. However, before taking out this type of loan, be sure that you will be able to make the monthly payments on time. If you cannot make your loan payments on time, this will be another negative mark on your credit report. Although the tax laws are complex, the majority of people can deduct interest on home equity loans secured by a primary or secondary residence. Make sure you talk to a professional tax advisor about your personal situation. Depending on the interest rates and the length of the loan, the total cost of the new loan might be much less than what you're paying in interest and fees on your current loan. You will still be responsible for paying off your other debt in full, so you won't be able to save money on the principal amount as you would if you chose the debt settlement option. You save money on interest if the loan term is reasonable. Maximize your savings by keeping the loan term short and calculate overall costs before making a final decision. There is no risk of legal action if you make your payments on time. However, if you fail to make your mortgage payments on time, your house will be foreclosed on. How soon this happens varies from state to state. The real risk is that you will use your credit cards all over again, accumulating additional debt on top of your existing debt from the home equity line of credit. If you aren't careful, there is the possibility that you will make your situation even worse than it was before. Make sure you can make your payments on time to avoid even more challenging circumstances. Number 3, unsecured debt consolidation loan. This option is comparable to debt consolidation, except the loan is unsecured. You are not required to use your home as collateral. Like the home equity loan, you obtain a loan to pay off your debts, leaving you with only one monthly payment. If you are paying off debts that indicate recent late payments, you are improving your credit score. You are also increasing the overall amount of credit accessible to you, which improves your utilization ratio and scores. The cost of an unsecured debt consolidation loan is determined by the terms of the loan. Take into account the interest rate and the duration of the loan. The loan might have a cheaper interest rate than your debt, depending on the lender, your credit, and your present debt agreements. It's also possible that it's even higher. High-priced loan offers are frequently sent by finance companies through the mail. Make sure you check out all of the terms. The terms are often comparable to the less desirable credit cards. The interest rate might seem reasonable until you are late with a single payment, at which point it can rise substantially. Your new interest rate will be in effect from the very beginning of the loan and will continue to be applied for the remainder of the loan. Preferably, you should get a loan from your bank, since you will likely get better terms. However, an unsecured loan from a bank is difficult to obtain, especially if you are behind on any of your debt payments. Number 4, credit counseling. This option enables a credit counseling company to work with your creditors to remove the penalties and fees and also reduce your interest rates. You make a single payment to the credit counseling company, which in turn distributes the funds to your creditors on your behalf. The credit counseling firm also gets paid out of these funds, so not all of your contribution goes to debt payments. Take into consideration how much the counseling firm is being compensated. Credit counseling is only beneficial if the savings surpass the fees. Many people have expressed dissatisfaction with credit counseling services. Unfortunately, there are unscrupulous businesses that will promise to do a lot for you but fail to deliver much in terms of value. Be sure to do your research and select a reputable business. As long as you adhere to the conditions of the debt arrangement, this choice will have no adverse effect on your credit score since your creditors have agreed to the terms. Finding a trustworthy credit counseling business can save money and time and also eliminate the stress of dealing with creditors. Number 5, Chapter 7 Bankruptcy. In Chapter 7 Bankruptcy, all of your unsecured debt is erased, so it will not help you with your mortgage or auto loan. When you file for Chapter 7 bankruptcy, the courts can take and sell your non-exempt assets to pay your creditors. Exempt assets are assets which cannot be sold, while non-exempt assets can be sold. Depending on the state where you reside, different rules apply to which of your assets are exempt and cannot be sold, and which of your assets are non-exempt and can be sold. This is rarely an issue since the majority of people who file for Chapter 7 bankruptcy don't have enough non-exempt assets to warrant seizing and liquidating them. Bankruptcy laws vary widely by state. Be sure to educate yourself before filing. Bankruptcy will have a negative impact on your credit score that can last for up to 10 years. However, most bankruptcy filers already have considerable debt and are past due on their payments. If your credit is already severely damaged, filing for bankruptcy is probably not as bad as you might expect. In most cases, credit scores increase once debt and late payments are paid off. However, it will be difficult to return to a high credit score anytime soon. Even if your credit score improves, the fact that you filed for bankruptcy will make it harder to obtain new loans or credit. For many creditors, having a bankruptcy on your credit report is an automatic denial of your application. In some situations, the courts can seize all or a portion of your tax refund. There are no further tax consequences, but you should consult with a tax specialist in your state for more information regarding your particular situation. While the cost of Chapter 7 bankruptcy depends on the complexity of your case, it is usually only a few $100s. However, future costs should also be considered. If you take on new debt, you might be stuck with increased interest rates for the next 10 years, assuming you are even able to get approved. Once notified of the bankruptcy filing, creditors are required by law to cease calling and harassing you. Number 6. Chapter 13 bankruptcy. While Chapter 7 bankruptcy completely eliminates most debts, Chapter 13 bankruptcy only partially discharges debts, while you continue to pay a portion of them. If you own a lot of personal property, Chapter 13 allows you to keep more of it than Chapter 7, and also effectively stops any foreclosure actions against you. Banks are required by law to allow you to catch up on your mortgage payments by setting up a new payment schedule. This is a major benefit of Chapter 13 bankruptcy if you are really behind on your mortgage or tax payments and want to keep your home. Make sure you consult with a tax specialist if you are considering Chapter 13 bankruptcy to resolve any unpaid taxes. If you hire a lawyer, the cost of Chapter 13 bankruptcy is usually around $2,500. This amount will vary depending on the complexity of your particular situation. As far as the amount of debt you must repay, that depends on your disposable income. Make sure you get all of the relevant numbers before you file. There are several ways to reduce debt faster than just making the minimum payments each month. Each of the options we presented in this video have their own pros and cons. Always evaluate the impact of your particular debt reduction choice on your credit score, taxes, costs, and potential for legal action. That's all we have for you in this video. Have you ever used one of the debt reduction strategies we discussed in this video to reduce or eliminate debt that you owed? If so, leave a comment and let us know which one you chose and how well it worked for you. What advice would you give someone who is considering that particular debt reduction plan? Thank you so much for watching. If you enjoy the information we provided, please be sure to hit that like button and subscribe to the channel. Check out some of our other videos for more great ways to make money work for you. See you next time, and take care.